Good afternoon, everyone. Welcome, and thanks for taking time to join this first Investment Watch seminar. I'm Jonathan Lee, the Director of Church Relations and Operations. My work is all about helping our members, congregations, and the wider United Church of Christ have access to and awareness of all things pension boards, and to provide a consistent point of contact to connect our members with whatever it is they may need. The creation of that position in 2021 and today's webinar are two excellent examples of the emphasis that our leadership, and our President and CEO, Brian Boettiger, is with us this afternoon, the emphasis that our leadership is placing on being responsive, transparent, and communicative in all that we do on your behalf. That is, of course, particularly relevant when it comes to our most important benefit, the annuity plan, and our investment performance and outlook, especially given current market dynamics. Our investment team, whom you'll meet and hear from in a moment, has fully embraced this opportunity to share their expertise and perspective on a regular basis through these webinars. And we hope you'll make joining in part of your ongoing relationship with the pension boards. We know that you have questions about investments and on other topics related to our benefits, so please make use of the chat feature during our time today. We have staff members from multiple departments ready to respond, and we'll do our best to post answers to all of your questions before we sign off. As we get started, I'll ask that you make sure that you are muted, as I will in a moment, to ensure our presenters fully have the floor. Again, welcome to all. And now I'll turn things over to our Chief Investment Officer, David Klassen. Dave.
Thank you so much, Jonathan. It is really it is a pleasure, and I'd echo what Jonathan said at the outset. We're so pleased that you've chosen to join us today. We've got an interesting agenda, and hopefully an interactive and brief agenda to cover the things that are hopefully on your minds, and also to give you confidence and comfort that your retirement assets are being looked at. Let me just outline today's agenda. So we will introduce ourselves a bit. We'll talk a little bit about the retirement plan structure and how it is set up for your success. Needless to say, the faith and finance moniker is so important to the ways in which we're investing on your behalf. And then in the back half of the presentation, we will spend a little bit of time, not too much time, on the market and fund performance and the outlook for markets, and at the same time give you a chance to interact with us. So without further ado, Jonathan introduced me. I'm Dave Klassen. I'm the Chief Investment Officer. Brief introduction. I joined the pension boards in 2011. I spent almost 20 years on Wall Street, and earlier in my career at Morgan Stanley and then JP Morgan. And then I got religion and decided to go to divinity school in 1999 at Union Theological Seminary. So I'm a chartered financial analyst and an MDiv. In the subsequent time following divinity school, I was heading up a leadership development company, and in 2011 joined the pension boards. And I feel fully prepared to lead the investment part of this organization, and in particular, so pleased to work with a team, some of whom are here today. So, Lon, why don't you just let people know who you are?
Well, thank you, Dave. Hi, everyone. I am Lan Kai, and I'm Deputy Chief Investment Officer. I joined the Pension Board of United Church of Christ in 2015. Before that, I was a portfolio manager at the hedge fund Millennium, and I also served as managing director and portfolio manager for a variety of multi-billion-dollar equity portfolios at PineBridge Investments. Like Dave, I have enjoyed working with investment team every day for the last 7+ years and going strong. Minothi?
Hi, everyone. My name is Minothi Dhanaraj, and I'm a senior manager of investment research focused on responsible investments on the team. And I have over 20 years of financial services industry experience, as well as graduating from the University of Chicago with an MBA in 2008. After graduating, I joined Neuberger Berman as an equity research analyst. And then I was a senior investment officer at the City of Dallas's pension plan prior to joining the pension boards in 2018. I'll now pass to Rick Walters.
Thank you, Minothi, and welcome to all of you here today. I was a local church pastor, began my career that way, became a practicing attorney representing religious organizations, worked as an executive of one of our UCC seminaries, and now as the director of corporate social responsibility for the pension boards. And with that, we'll go back to Dave.
Sure. Well, thanks for all that. And just know that this is a smaller part of a larger team. We are buttressed and bolstered by an investment committee of the Board of Trustees, aided by an investment consultant who helps us with a lot of analytics and manager research, and a fixed income team who is directly responsible for managing almost $800 million of your assets. So now that we know who we are, we'd like to know a little bit more about you. Stephen, I think you prepared a little bit of a poll that we might pull up right at the moment. So if you wouldn't mind answering and being interactive with us. Obviously, we know there's lots of concerns in the marketplace these days. What is your primary financial concern? Give you a little bit of time to answer. So as we thought, having enough money for retirement, we are here to help your retirement outcomes. Stock market and economic downturn is obviously in the headlines. And thirdly, but probably equally as importantly, the rising cost of goods and services. So thank you for your participation, and we will orient our remarks to your concerns. Of course, Stephen, if you go to the next page, I'll start things off. You know that our primary methodology, a primary means for helping you with your retirement is our pension plan. The pension board's pension plan is a unique construct. The bottom line is that you cannot outlive your money. But on the left side of the page, you see the funds that we offer for you during your active phase of employment. There are 11 curated funds that are diversified and are made up of the top managers that we can select on your behalf, including firms like T. Rowe Price. As you near retirement, we transition you through the use of target date annuitization funds to the ability to choose one of two annuities, the participating annuity or the basic annuity, which again guarantee income for life. So 11 funds during your employment years, including target date annuitization funds, which transition to lifetime income annuities. And I would also mention that we have, on the call here, a number of our pension counselors. I think you know Anna Blandino and Baharu, who are able to assist you and prepare you for retirement. And here we want to spend a little bit of time talking about the integration of faith and finance into the retirement portfolios. Minothi?
Sure, thanks, Dave. So Rick and I will be sharing more in terms of our framework for ESG and impact investing. But before we do, I wanted to share a few key terms that are important to know. The first is environmental, social, and governance, or ESG. This refers to a set of standards for a company's behavior used by responsible investors to screen potential investments. So an example of environmental would be climate change or water usage. An example of social would be human rights. And an example of governance would be board diversity or executive compensation. The next word is impact investing. And that is an investment strategy that seeks to generate financial returns while also creating a positive social or environmental impact. So going to the next screen, this is really our faith and finance framework, which means doing good for creation and humankind, and also doing well with financial performance for our members and our faith communities. So we have 5 key areas of focus within this framework, which include alignment, ESG integration, impact investing, corporate engagement, and collaboration. So starting on the left-hand side with alignment, this is incorporating a lot of our exclusionary screens that align with our core values. So at the bottom there, you can see some of the areas that we have exclusionary screens, including firearms, tobacco, gambling, and thermal coal and tar sands. We also have a global sustainability index fund that we introduced in 2015 that focuses on the leaders in terms of implementing ESG. We then move to integration, and that is ESG and DEI, so diversity, equity, and inclusion integration in our due diligence process. At the bottom there, we have shown an example of one of our managers in the portfolio, which is Lombard Odier's Climate Transition Fund. And this fund really invests in securities focused on both climate adaptation and solutions. And I'll give one example of a company that they've invested in, which is Nike. And Nike has set a goal for 2025 to use 100% renewable energy in owned and operated facilities, and is sourcing innovative low impact materials and using recycled polyester in their products. Then moving to the third pillar, which is impact investing. And these include strategies with the intention to generate measurable social or environmental impact with the market return. An example of one of our managers within this portfolio is Neuberger Berman's Private Equity Impact Fund, which seeks to provide social and environmental outcomes that are aligned with 15 of the UN Sustainable Development Goals. An example of one of their investments is a point-of-use water filtration and dispenser company that is displacing plastic water bottles. I'll now pass to Rick to discuss more on our 4th and 5th pillar.
Thank you, Minoti. I'm going to make a couple of general comments about the faith and finance framework and then move to a specific comment about this last category of responsible investing. It's important to note that we don't want to sacrifice returns, but at the same time, we want to fulfill a moral responsibility. In fact, I could argue that all investors have a moral responsibility to the wider community. This is a concept sometimes referred to as universal ownership. And the importance of that is that we work very diligently to incorporate social responsibility into all aspects of what we do, not only in investments, but in all of our work as the pension boards. And that really comes out of this general commitment to the faith and finance framework. Secondly, you'll note these really 5 different kinds of strategies for doing the integration of social responsibility into our portfolios. And that's very important. Many people think that the basic way of introducing responsibility is to in what we don't invest in. That's that far left-hand column. And we're all familiar with models in which we refrain from investing in certain aspects of the markets. But there has been a revolution in how socially responsible investment can be executed. And it actually exists of a much broader spectrum of different strategies, as you see here. And I just wanted to let you know that you can read more about this by going to our website and reading our 2022 Sustainable Investment Report, or going to the website of the Interfaith Center for Corporate Responsibility, that's iccr.org, and reading about this next category I'm going to describe. In addition to these strategies that Minotti has described, we also have conversation and dialogue directly with the companies that we invest in. There's an example there with FedEx, which was a shareholder dialogue we had last year in the last proxy season, and in which we filed a shareholder resolution that went to all the shareholders to vote upon. And what we were trying to do there was encourage the company to continue in its pathway to net zero by 2050 in alignment with the Paris Accord, and to also align their trade associations with their own internal climate goals so that the lobbying money that they're spending in Congress is consistent with the type of approach that they were taking to climate change, which included the use of alternative fuels. So it's really important that we have these due diligence dialogues with companies to encourage them to be better citizens of their communities and of their world, along with the general moral responsibility that I've spoken about. Also, we collaborate, and I mentioned ICCR, the Interfaith Center, and that's important because we leverage up our influence by working with other faith-based investors. In fact, ICCR, which has been in existence for 50 years, we were one of the founding members of that organization, is next to the councils of churches, one of the largest ecumenical organizations that the UCC participates in. And it's dedicated solely to influencing the influence of investors who are faith-based upon this sort of social responsibility approach to developing companies into better citizens. There are many examples of other organizations, including secular organizations that share our values, in which we also align together and create a multiplying effect. So for instance, just to say that we have about $3.5 billion in assets under management at the pension boards. But when we join together with the 300 faith-based members of ICCR, that figure goes up to something like 300 billion. And so with that kind of influence, we can go to companies and we can get real dialogue going. I want to leave you with the idea that all of us can be responsible investors by what we choose to do with our money. And so it's not just the pension boards, but it's everyone who can get involved with this exciting development and part of the work that we and others are doing in the contemporary markets. And so now with that, we'll return the discussion to Dave.
Well, thanks so much, Rick and Minotti. So let's keep things moving, and we'll pivot now to probably one of the major reasons why you joined us, and that is concerns about the market, updates on fund performance, and a little bit more on the outlook before we wrap things up and re-engage. No question, I'm sure you feel it in your bones, 2022, last year, was a difficult year. And it was a year where diversification, that is spreading your assets amongst different asset classes, didn't help much. And to give you a little sense of how unusual that is, we have a chart on the right side of the page which shows the annualized returns of something called a 60-40 portfolio. Now, a 60 portfolio is just simply a moniker for a balanced portfolio of equities and fixed income, stocks and bonds, in a relationship of 60-40. This chart goes back to the 20s, almost 100 years ago. And you can see the right side of the page shows this was the worst year since the 1920s, for the balanced portfolio. Usually when stocks zig, bonds zag, and you get some benefit. But this was a year when both stocks and bonds, the foundation of a diversified portfolio, really did not perform. And so we'll talk a little bit more about the whys and the forward-looking. Before that, let's go to the next page, Stephen, and just outline briefly how this impacted the pension board's funds for accumulants, for accumulating members, that I outlined at the beginning of my part of the presentation. So as you know, there are 11 accumulation funds: Stable Value, Bond, Equity, Northern Trust, Sustainability Income Fund, the Sustainable Balance Fund, and the Target Annuitization Funds, which have a mix of equities, fixed income, and stable value according to the year in which you're retiring. And you can see that that there's been solid performance for all 11 funds, but last year, all but the Stable Value Fund have been dramatically impacted by the market declines, both in the short term and in the longer term. In terms of the target annuitization funds that you've heard us speak a lot about, that we try to guide you to, if you are not a do-it-yourselfer, you can see that they have basically done their job. So for example, if you are invested in the 2025 fund, thinking about retiring and annuitizing in 2025, it did a pretty good job of protecting principal and was down only 10% for the year, in a context when equities were down 20% and bonds were down about 15%. And that's because it has this heavy dose of stable value. So more about that, at other points, and certainly our pension counselors are able to guide you to financial planning. But I just wanted to give you a little bit of a summary about how our funds were impacted. Maybe turning to the next page, many of you may be annuitants. You've already retired and you've decided to annuitize and select lifetime income in either the basic annuity or the participating annuity, or one of the older pre-2006 annuities. But I thought, Lon, maybe you could give us a little bit of an update on the annuities themselves, how they've been performing in this market environment, and any other tidbits.
Yeah, well, sure. Thank you, Dave. So for the annuitants, this is a chart to look at. And then I do have a piece of good news despite the market declines. And that is both basic annuity and participant annuity are in good shape. They are well-funded. Well-funded means that the assets in these programs can meet all the future obligations of the programs. And that is important because early on, Dave mentioned that the basic annuity and participant annuity provide lifetime income to our members, to our annuitants. And I'm almost sure that all of us here would love to see this program outlive any one of us on this webinar. And I think we're in good shape. If we turn to the next slides, we can show that these two programs are structured differently from the prior balanced and equity annuity program. They're structured in a way that it will provide stable lifetime income to our members, that it will do its best to insulate from market movements. And when it can, it will provide increases. So if you look at the performance of these two programs, since its inception in 2007, there is no cut in benefit payments. Despite the great financial crisis in 2008, despite the pandemic in 2020, and despite the market declines in 2022, there are no cut in benefits. There are 7 increases for the participant annuity, and there are 3 increases for the basic annuities. And I know that there are a lot to digest, if you're more interested, please visit our website, pbucc.org. There are information about these two programs, and there are also webinars. You can also learn more from Newton's Visitors Program and your lovely member service group here at PBUCC. But over the years, we made numerous improvements to the programs, and it now managed in high precision level, which means that we're reasonably comfortable that these two programs will provide you stable and hopefully increasing lifetime income to our members, to our Newtons. And with that, I'll get back to you, Bay.
Yeah, thank you, Lon, and particularly in the participating annuity. And so, you know, a lot of work to professionalize and to make these annuity programs as sophisticated as anything that can be bought, you know, outside or acquired outside. So we're going to put you a little bit on the spot here, Lon. A little bit, just one more time. Lon really serves, you know, as one of our more astute market folks. And Lon, without turning this into an investment committee or a report to our trustees, why don't you spend a little bit of time on, you know, kind of what's happening in the market and what the outlook is. But then we'll open it up to summarize and open things up to questions.
Okay, I will try. So maybe I use 3 slides to describe what happened in 2022, what we look out for 2023, and then where we are in the cycle. Maybe those are the questions that on everyone's mind. The first chart is really the S&P 500 index, and that reflects a broad equity market in the United States. You see a lot of zigzags. Market always fluctuate, but visibly there is a big bull market from 2009 to 2019. And you all know what happened there. After the great financial crisis in 2008, central banks around the world, in particular Federal Reserve banks, has put a very accommodative monetary policy to rescue the economy and then rescue the market, where the market has increased about 400% over that time period. And it came to an abrupt pause in March 2020. That was the pandemic. And because of the pandemic, government responded very strongly. And this time, not only in the monetary side, but also provide huge fiscal stimulus. You all heard about the $1 trillion CARES Act and so on. So it did kind of help the economy from almost a meltdown to a strong recovery. And then that recovers along with the market. It was a big rally. One can almost argue that Fed probably stayed on this easy policy for a little bit too long in the face of rising inflation in 2021. They finally realized that at the beginning of 2022, and then they act on it. They act on it in a way that they raise interest rate at every single Fed meeting since March 16 for a total of 425 basis points. It's a lot. It's unprecedented, almost unprecedented.
Yeah.
And this is where it got back to your first chart, Dave, that it's a very rare year where you see both bond market came down because rates go up, and then also equity market came down with this reaction towards the fast and furious movement from the Fed. The good news, if we turn to the next page, that the Fed will likely to pause sometime this year and maybe this first half of this year after this aggressive rate hike. They will probably pause and then on hold and then see how the economy react. The inflation's already started to come down. It will come down a bit more. And then so we probably passed that fast and furious adjustment period. Looking forward, earnings is everyone pay attention because the multiple has adjusted to a reasonable value for the equity market. And really we wanted to see if the earnings can come through or if there will be any weakness in the earnings when you have a rising possibilities of recession. But earnings come each quarter, so it will be a slow process. We highly doubt that you will see the market volatility like in 2022, again in 2023. But again, I think that we all pay a lot of attention towards earnings and then the possibilities of recession, and then to see how the asset class react to that. Mm-hmm. If we turn to the next page, and this again gives you a 100-year perspectives, because we all kind of noted the last 12 months or 14 months is a bad market. Unfortunately, both equity market and bond market. But if we look at the last 100 years, bear market usually lasts about 20 months, and bull market is much longer. It's 50 months, 51 months on average. And we already had 12 or 14 months bear market. So we have something to look forward to. And as mentioned, that if equity can come through and if there is no recession, stock market is in a reasonable place. Now I know that there is two big ifs, and therefore there are a bit of uncertainty here, and then therefore that we will vigilantly look after earnings and the possibility of a recession. On the other hand, fixed income market is in a better spot, because with the rates coming from 0 to over 4%, one can easily compose a portfolio using US Treasury, investment grade, and high yield, and have a kind of 7 to 8% yielding portfolio. This is probably one of the most attractive portfolio one can have over the last 15 years. So we have some uncertainty on the equity side, but I think fixed income is looking good. We will have probably sessions in the future, the webinars to drill deeper in the fixed income, because we do have a fixed income teams. They certainly know a lot more than me. But I think overall, we're in a better spot, and then something to look forward to. I don't know if that makes sense, Dave.
Well, it does. And I think another way of saying what you said, Lon, is that the stock market has adjusted to higher interest rates, but maybe not the possibility of some lower earnings. That the fixed income market is more attractive because your starting point for yields is a lot higher than it's been in any time in the last 10 to 15 years. So more attractive. So it sounds a bit more like the 60-40 portfolio or the balanced portfolio, or some of the targeted annuitization strategies are at a better starting point than they were last year at this time. So enough on markets. Maybe we can just summarize and see if there are any other thoughts or questions from you. I think we've talked about the 2022 bear market with returns down over 20% at one point. There's been solid relative performance by the pension board's accumulation funds, the 11 funds versus peers, and appropriate for what's happened in the market. You heard a lot from Minothi and Rick about the ways in which the pension board's funds, both in the accumulation and the annuity funds, are aligned with values through our faith and finance framework using ESG and impact. Lon talked a bit about what could be next. We don't give advice, but we are trying to frame things for you. And again, our member services folks can connect you with financial planners at Ernst & Young and help guide you. And I would say that the most important thing that you can do is to have the appropriate mix of stocks and bonds and cash in the portfolio for your situation. Which is why we've guided you over the years to the target annuitization funds, which are customized to your retirement date. So with that, I think there may be a question or two in the chat. We really want to thank you for your attention today to us, and just know that our attention is directed toward you constantly and consistently. So Jonathan, at this point, I might turn it back over to you. There might be a question in the chat if I missed one.
Yeah, there was a question asked in the Q&A, and Lon was typing an answer, so I think we'll get the answer to that. And we'll just wait a second to see if there are any other questions. Now is your opportunity, friends. And of course, I hope you all heard the message that if you have questions that we weren't able to address, or you have questions about anything related to pension board's benefits and the way we do our work, please reach out to us directly, and we will do our best to respond when the webinar is over. Okay, so given that it doesn't appear as if there are any more questions, although now they're coming in, here we go. There are a few in the Q&A, panelists.
There's a thank you. There's a trying to access the web, which we'll attempt to fix. We have a few hands up. We have maybe just briefly on Lon, just on a debt ceiling concerns. Any thoughts on how the debt ceiling concerns might affect the markets over the short term here?
Well,
and
yeah,
go ahead.
Partly answered in the Q&A that we saw this movie a few times already. It's kind of a drama, but then in the end, it all got resolved the last minute, and then really last minute, literally. Here, we probably will get resolved last minute too, although Yellen has instituted a program where it gives 5 months period from now towards really the heat of discussion of debt ceiling. And the new House Speaker has some information, but then Democrats don't want it to discuss. So there's a lot of news, and I think that it's interesting if one wants to pay attention to the subject. Mnuchin talked about this at the Davos today. He says this is a drama, but the U.S. always want to pay and will pay debt. Bill Dudley has an op-ed yesterday. The debt ceiling become a tool for both parties, and then I think hopefully it will put some pressure for both parties to come together to resolve this. In the short term, market will react, but given that it is being played a few times before, the market may not kind of overreact in the situation.
Right. And then just one more question. We're up against a little bit against time. And the question is a good one. Is the basic annuity a better place to be right now rather than the participating annuity? Tough question, because it really depends on what it is that you're looking for. The two annuities are a little bit different. But in general, the participating annuity is designed. Well, let me just say one thing about the annuities, and that is both annuities are equally funded in the same vicinity. So the ratio of the assets that we have to all future obligations that we have to you is equal. So there's no preferential treatment. And as you know, the participating annuity is designed to allow for increases over the years, because it is positioned in global equities and a number of multi-asset alternatives, as opposed to just fixed income. So I would advise you to chat with our pension counselors, as indicated in my earlier slide, to make sure that I'm answering your question particular to your situation. We have the member services line here, and at this point, I've been given license to close things up. And on behalf of Brian Bottiger, our CEO, and all of us, our staff investment team, we want to really thank you for your time today, and hope you enjoyed it, and hope you got some information. And again, know that we're here for you. So thank you. Have a good rest of the day.